All right, today we are going to have a ton of fun. We are going to look at MassMutual's whole life insurance products that comply with the new 7702 update. This was one of the most intense updates I've ever seen, only because MassMutual has made changes that are literally 4x, so 4 times greater than what other companies have done. Specifically, it has to do with where they file the guaranteed rates on different products, but we're going to have some fun and really dig into it. The purpose of this video is really to provide transparency on the different options available. So today we're going to solely focus on MassMutual. Earlier in the year, we went through Guardian's 7702 update and their different products and really the impact it has on maximum cash value, guaranteed and non-guaranteed values. This will be very similar, but a bit longer just because MassMutual made a lot of changes. So let's get into it. First and foremost, what we're going to look at here is a comparison of the old and new whole life insurance policies. This way, if we're used to the old products, what we've been looking at for a long time, like what impact has occurred? If I'm looking to put money into a whole life insurance policy, and I've been used to looking at MassMutual policies for a long time, and I'm considering a new policy now, what are the actual differences? We are going to touch on that. Some additional information. MassMutual has declared their 2022 dividend interest rate, 6%, exactly the same as the 2021 dividend rate. And in case you're new to all of this, always remember that the dividend rate is a gross rate. It is not what your money is actually growing by in a life insurance policy. So as I hit on earlier, MassMutual has made the most significant changes to their whole life insurance portfolio. This specifically has to do with their guaranteed rates. When you look at MassMutual, they have selected 4 different guaranteed rates, which we're going to hit on in a second, whereas most companies, not all, but most companies out there have filed 1 guaranteed rate for all of their products. For example, if you look at Guardian, which we touched on earlier in the year, their old products, all of their old products had a guaranteed rate of 4%. All of their new products, so with Guardian specifically, all new products have a guaranteed rate of 3%. If you look at New York Life, another one of the major mutual companies, all products have a guaranteed rate of 3%. If you look at a smaller company that a lot of people are familiar with, Penn Mutual, all products have a guaranteed rate of 3%. So these are all based on the new 7702 updates. Their old products, all companies had a 4% guaranteed rate, but we see that across the board, they're saying, hey, here's a 3% guarantee. This is exactly where we're going to file our products. MassMutual did things much differently. So to get into it, Mass, with their old products, Legacy Series. So anytime you see an old product, it'll always read Legacy Series, has a guaranteed rate of 4%. Since they declared their total dividend interest rate at 6%, that means they declared, oopsie daisy, a surplus rate of 2%. That's how dividends work with whole life insurance policies. Whatever the total dividend rate is, it's going to result in a surplus rate that will always be the difference of the total declared dividend interest rate and the guaranteed rate. Again, if you Google search MassMutual's 2021 or 2022 dividend rate, 6% pops up. If you've got an old product with a 4% guarantee, that means the difference, 2%, is their surplus rate. Now, one thing, I almost neglected this, depending on when you're watching this video, this may or may not be relevant, is if you still want the old product after looking at everything, you can still get that, but MassMutual's cutoff is that an application needs to be signed, so e-signed by a potential policyholder, by you if you're considering a policy, on or before November 19th. So depending on when you're watching this, that may or may not apply. All right, so getting into the new products. We mentioned Guardian, New York Life, and Penn as 3 quick examples. Here's the big difference. You've got your whole life 100, which means you can make payments up until age 100. You don't have to. You can easily fund it for 5 years if you want to. We ran a number of scenarios that we're going to look at as well. But that is a traditional whole life insurance policy. Here's the change they made. Guaranteed rate, 3.75%. Slight decrease from 4%. That means the declared surplus is 2.25%, same total dividend interest rate of 6%. That total dividend rate will never change. The surplus crediting rate is what's going to adjust, which will impact this when you look at different life insurance illustrations. Dividend column on an illustration, we'll touch on that in a little bit. If you look at their high early cash value, whole life 65 and 20 pay product, the guaranteed rate is 3%. So that high early cash value product, you'll see about 90% of the base premium show up in cash value in the first year, very cash rich upfront. Over the long haul, not quite as attractive. When you look at the overall policy design, if you take an L100, for example, when we look at policy design, where can your money go? Premium or PUA dollars? I've got my cash value and death benefit here. This will look familiar if you've ever seen any of our content or any of our videos. So premium dollars, anything you pay into the product with respect to your cash value, nothing shows up in the first and second year. This is specific to the whole life or the whole life 100 product. The reason why is the company is overcharging us for the death benefit up front. Whereas PUA dollars, this is what everyone is attracted to, shows up in cash value, we can access it, begins to earn the guaranteed rate, begins to earn dividends. It's the key to accelerating everything. Now, to get back on point here, that high early cash value product. So the difference with this guy is if we look at everything the same here, but the high early cash value product, there's a big difference. I'm going to do it this way. That premium piece, with respect to any money that goes there, what you'll find is about 90% of the base premium shows up in cash value in the first year alone. So that gives you an earlier break-even point. A lot of people can be attracted to that. However, the key difference is with the L100, the company is really overcharging us on the base premium dollars in the first and second year. Those are the heaviest expenses. Whereas with the high early cash value product, they're giving us the money. So if I'm the policyholder, they're giving me that money up front, all but 10%. But when you actually study the product, it's a bit more expensive over time. What they do is charge a higher expense, but they spread it out over the life of the policy. And what ends up happening is you often see less cash value in that product over the long haul. So high early cash value, kind of the name, gives you more equity up front, but not quite as much long term. Their whole life 65 means you can pay into it for a maximum of up until age 65. And then their 20 pay product means you can pay into it for a maximum of 20 years. So we don't have to pay into it that long. So for example, with the whole life 65 product, what that means is if you're looking at that product, pretend it's you, you can make payments up until the age of 65. You cannot go longer. However, you can go shorter if you decide to do so. What you're going to see in the examples is we ran all of these, funding it for a long period of time, and then also for 5 years. A lot of people are attracted to seeing examples of stopping the payments in the event that life happens. Hey, what if life happens and I can't pay money in any longer? Or what if I have a lump sum and I only want to pay into it for, call it 5 or 10 years? We get that quite a bit. Of course, it's always up to you as the individual at the end of the day, and that's where options are great. As we look at their other options or other products, their whole life 15 pay. This, as I study all the options, if you're an individual that says, hey, I'm considering funding a policy, I've got a lump sum of money, I want a max funded policy. I want flexibility to adjust my payments one time per year without any medical underwriting. Mass Mutual allows that. You can design a policy quite nicely. But if you like a policy to fund for a short period of time, or say a maximum of 15 years, as I examine the new products, this option I really like because you can blend it quite nicely with different riders, have rich upfront cash value, and reap long-term benefits. So it's got a lot of advantages there. The guaranteed rate, however, is only 2.5%. That would be the drawback. But when you look at it, they also cut the insurance expenses. So it's not a huge impact, but we'll get to that shortly with the numbers. And then their whole life 10-pay product, the non-guaranteed cash values are extremely attractive on this product. However, it's very dividend sensitive. So without getting too deep into what that means, is the lower the guaranteed rate, the greater the surplus rate. So what this means is if I look at their new 10-pay product that has a guaranteed rate of 2% and a total dividend rate of 6%, that means that the declared surplus is 4%. If the dividend rate, say, comes down to 5%, what would happen here is you would have the same guarantee of 2%, but the surplus would now be 3%. And that will impact the performance quite drastically. In fact, let's take a look at that real quick. So we're going to look at the old and the new here. We're going to look at a lot, but I do want to touch on this piece because this is fairly important here. So here we've got the new 10-pay product designed for maximum cash value, 1090 split, all that good stuff. So what we have here is a true 7-pay, meaning we have a policy with a $100,000 MEC limit, and we can see that here. So death benefit, 1.49 million. What does the MEC limit have a direct relationship to? An individual's age and total death benefit. This is a 40-year-old male, $100,000 MEC limit. So we're funding up to the IRS limit. Mass Mutual, as a company with all of their products, wherever you set the base premium, their limits allow for a total payment of 10x, 10 times their base premium. So if I'm working with someone that says, Steve, I'd like to pay in $100,000 per year, that's the maximum I'm ever going to want to pay in, and I want maximum cash value, minimum expenses, minimum commitment, because I'm interested in the cash, and they like Mass Mutual, the lowest we could set that premium is $10,000, which, look at this, cash value right off the bat, almost 90% with this option. Break even, year 4. So this is the new product with a guaranteed rate of 2. And this is based on the current dividend interest rate, meaning I have a surplus of 4% for the total dividend that's assumed here of 6%. And we could fund it longer for 10 years, but we just did a 7-pay in this example. So I could fund right up to the MEC limit and maximize everything, really minimize expenses. But let's take a look here. If we go down to year 30, 70 years old at this point in time, what is your cash value? 2.25 million. There's my cash value column. Okay, good. Back to this guy, 2.25, let's call it. So this is based on the present dividend schedule. So here we see, based on the 2022 dividend schedule. Now, let's take a look at the exact same product, but I kicked the dividend rate down to 5% in this example. This is also important when MEC testing a policy to look at conservative dividends, which if you're an agent, you need to know that in and out. But identical policy, same design, $10,000, same term rider, everything attached, everything is identical here. 100K in, total cash value the first year, not much of a difference. This assumes a dividend rate of 5% from year 1. the last example, your break even was year 4. So by year 4, you already see a $10,000 difference. That is an impact here. If we look at this guy, the dividend column, 8709, and again, so to be clear here, this is the new product, guarantee of 2%, surplus of 3%. So I ran this a bit more conservative, total dividend at 5%. Okay. Year 4, 8709. Shall we go back to the last example? Let's go to year 4, 12685. Go back to the new one, 8709. That's significant. So the purpose here, what I'm getting at, what I want to illustrate is the lower the dividend rate, the more sensitive the product will be when I have a lower guaranteed rate. And why this change occurred, this 7702 update, is really because insurance companies feel that the low interest rate environment is going to remain low for at least 10 years. They stated that beginning of 2020, so call it up until 2030. Will that actually happen? Who knows, because so many things change all the time. But you've got some of the largest institutions in the world, some of the smartest people in the world that have their investments out there, like they lobbied for this change for a reason. So I do like to look at things conservative. When we look at the long-term impact here, 30 years, cash values, 1.76, so almost $500,000 less. Now, again, this is a bit extreme because if you started a policy today, you've got a dividend interest rate of 6%. It's not going to drop to 5% tomorrow as they're declared annually each year. But again, this is the kind of stuff we like to look at and analyze when making recommendations to clients, to people we work with. If they're not asking the question, because not everyone likes to dive this deep, we'll ask the question for them or say, hey, by the way, it'd be good to be aware with this 10-pay, while it looks good on the non-guarantees, here's where it can be a little bit less attractive. If dividends come down, you will see the performance not quite as attractive. And of course, we keep you up to speed over time with our review meetings and calls every 6 months. But that kind of stuff is really what we want to touch on with everyone that we work with. And if I'm working with someone, I appreciate it when people go through that kind of stuff with me. So let's continue on here. Going back to the new product, that's what we had here. Or that was with the current dividend rate. So to wrap this up, this point here, the lower the guaranteed rate, the more dividend dependent the product is, meaning you're more dependent on what the insurance companies, what they're doing with their investments, what they're able to declare as a dividend interest rate, which in many ways does shift some of the performance risk back to the consumer. But again, the product, I state this all the time, a whole life insurance policy, when things are done properly, properly designed with one of the major mutual carriers, should deliver somewhere between 3 to 5%, new or old. Okay. So some differences there. We are going to provide more information on that as well. Let's touch on something important here that we've touched on in recent videos, MEC limit awareness, because this is huge. When designing a policy, we've got what limits to be aware of. One, we have the insurance company limits. So this video is specific to Mass Mutual. Mass Mutual, regardless of the product, wherever you set your base premium, your total payment is limited to 10x that base premium. So if you have a base of $10,000, that means you can pay in a total of $100,000. Why I so frequently ask, how much do you want the ability to pay into a policy on any given year? Really has to do with how low do I set the base premium to minimize costs? And then how do I make it flexible? Because if you do everything right with a Mass Mutual policy, meaning we use the proper riders, you can easily adjust payments one time per year, every year on your anniversary date when your premium comes due, without any medical underwriting. Now, if the design is critical, that LISR rider is key. We'll always typically do a combination of LISR and AILR. But first limit we have here, the insurance carrier limit, and then the other limit we have is the IRS, which the IRS limit is this MEC limit, which stands for Modified Endowment Contract. If a life insurance policy becomes classified as a MEC, what will happen is your cash value still grows tax deferred. The death benefit still paid out income tax free. But if you ever want to access money, and this is specific to a MEC, any of the gains, you do have to pay taxes as ordinary income, not capital gains. And if you're under the age of 59 and a half, there's an additional 10% penalty tax. Basically, we don't want a MEC. It takes away the third core benefit of cash value life insurance: safe, liquid, and tax-free. You can tell that you're a true insurance nerd when you have fun talking about life insurance. And that is a joke at myself, making fun of myself. All right, so as we look at the differences here, let's use an age 40 male. Looking at the old product, or the old guaranteed rate of 4%, these are ballpark numbers that are very, very close. I rounded here. $2.8 million in total death benefit with just about any life insurance company, regardless of the company you select. If you had a 4% guaranteed rate, $2.8 million for a 40-year-old male gives you a $100,000 MEC limit. As the guaranteed rates go down, what do you notice? So assume you're a client that says, or an individual that says, I want to be able to pay up to $100,000 per year. I don't want to get billed for that. So I only want to commit to 10K per year, but I'd like to pay up to 100K per year. And I want the minimum death benefit possible because I want the minimum cost cash value. Like, that's my interest there. If that's the case, what do you notice here? The lower the guaranteed rate, the less life insurance I need to obtain that same $100,000 MEC limit. Now, why this is so important for you as an individual considering a life insurance policy, or for you as an agent if you're trying to improve your practice, is when I look at options, if you're shopping and looking for comparisons and you say, hey, I want things apples to make sure that the individuals I'm working with are really doing things in my best interest. What you could do in the past, when you had that 4% guaranteed rate, is the death benefit would be almost the same regardless of the company and product. Very similar. Not going to be the case anymore because of these different guaranteed rates. So whenever we want to see an apples to apples comparison, here's what I would look at. What is the policy design? Specifically referring to the premium and PUA ratios. How aggressive will a company allow me to go? So here, Mass Mutual allows you to 10x the base premium. 10,000 premium, 90,000 PUAs, about that, a little bit of that PUA goes toward a term rider, but that's aggressive as Mass Mutual allows you to go. Then Guardian, New York Life, Northwestern all have slightly different limits, very close with the major mutuals to that 10x limit, but they all vary slightly. Then smaller companies have different limits. Some don't have any cap, but that's not here now. All right, let's continue. Main takeaway. So insurance company limit and then MEC limit, especially if you're comparing different life insurance companies. If I'm you, like if I'm the policy holder, just with the insurance knowledge I have, what I'd look at is to say, okay, are all things equal in terms of the policy design? Meaning, is the premium minimized? And then is the MEC limit the same on each product? If my goal is maximum cash value, which is exactly what corporations do when they are maximizing cash value policies to position as an asset on the balance sheet. When we design policies for corporations, that's exactly what they want. So some awareness there on the guaranteed rates and how that impacts the MEC limits. Loan interest rates. There have been some changes here. Looks complex, it's really not that complex. So starting with the old product, the Legacy Series, 4% guaranteed rate. Two options are available with that product when you start the policy. I want to emphasize starting a policy, meaning once you start a policy, you cannot adjust the loan interest rate. If I select variable interest rate, that's what I want. I'm locked in at variable forever. If I select fixed, I'm locked in at fixed forever. Most people select the variable loan interest rate for two reasons. It's non-direct recognition, and also this is specific to Mass Mutual. It allows you to attach that LISR rider, which again, the key advantage to that is it gives you maximum flexibility. You don't have to deal with headaches down the road if you need or want to adjust payments. But with the old product, that variable loan interest rate has a 5% floor, meaning that's as low as it can go. It uses Moody's Corporate Bond Index as a gauge, which has been much lower than 5% for a long time. Now, what you'll notice here is that the loan interest rate is always 1% greater than the guaranteed rate. And that is specific to the variable loan interest rate. So, for example, here, a 4% guaranteed rate, that's the guaranteed floor, which is a gross rate. I'm not earning 4% on my money. That means the variable loan rate, the floor is 5%. So worst case scenario, I see that positive 1% spread on paper or negative 1% spread. Reality would be much more worse than that. Why? Because that guaranteed of 4 might give me a net IRR 2.5% as time passes, if all things are done properly with policy design. But main takeaway here, 1% spread you'll see there. Fixed loan interest rate at 6%, meaning it's 6% forever, can never change. That is direct recognition. And right now, a lot of people aren't aware of this. Mass Mutual's direct recognition treatment is pretty sweet. What they do when you borrow against the policy, they apply a different dividend rate to loan dollars, but they raise it quite substantially. It's much higher than the current dividend rate of 6%. So when you loan and repay, you see much greater value in your cash value and death benefit. The thing though, with that, that's very important, that'll likely stay intact for a while as the interest rate environment remains low. However, if I wind the clock back about 7 or 8 years, it was the opposite, where they applied a lower dividend rate to borrowed funds. So with the fixed loan interest rate and that direct recognition, the company maintains a lot of control there. And we've got other content that goes into more detail. You can reach out to us anytime if you have questions on that or questions on anything or any company with high cash value life insurance. All right, so let's continue on here. So that's the old product there. Main thing is the 1% spread. If I have a guarantee of 4, that means the variable loan interest rate can be no lower than 5%. With the adjustment, here's the big thing. Variable interest rate, same thing with the 1% spread. But you've got 4 different products, 4 different guaranteed rates depending on the product you select. So they're whole life 100. Guaranteed rate of 3.75%, which means the variable loan rate floor is 4.75%. High early cash value, whole life 65, 20 pay, guaranteed rate of 3%, variable loan interest rate floor, 4%, 1% spread. Same thing, 15 pay, 10 pay, 2.5 and 2%, then the variable loan rates, 3.5 and 3%. Now, that 3% loan interest rate looks very attractive when you run loan models with a life insurance policy. Consumer awareness, and we use Mass Mutual, I'm a fan of them, but that 3% loan interest rate is very close to Moody's Corporate Bond Index. So if interest rates do come up a little bit, and say they're at 3.25, 3.5%, you will see that loan interest rate move up over time, which is just good to be aware of when I'm looking at dividend interest rates, loan rates, especially if you're modeling income or saying, hey, what company gives me the cheapest cost to borrow? Important to look at that kind of stuff. Not to say it's a bad product. I mean, interest rates will likely stay low for a little bit here yet. But again, look at everything objectively, pros and cons, even when I'm a fan of different companies. At our company, IBC Global, we primarily use MassMutual and Guardian. We do use other companies as well, but primarily Mass and Guardian, two of the four major mutuals that have a lot of flexibility. Being the four major mutuals, they have consistently delivered among the strongest actual performance, actual cash values. So new products, I almost forgot here, the fixed loan rate has not changed at all. Still the same 6%. Let's continue on. Some key observations. We're going to go through this and then look at some numbers here. So key observations. Old product, a lot like past videos we've reviewed, stronger guaranteed values across the board. They're not hugely significant. And the main reason why is with this 7702 change, lower guaranteed rates result in lower death benefits, which ultimately result in lesser costs, especially when you look at term rider costs, other little things that add up. So granted, the guaranteed rates, which have a direct impact on guaranteed values, have come down. Costs have come down as much, costs have come down as well, which does help offset things a little bit. I know there's been a lot of fear just with individuals and people thinking, hey, I got to get the old product immediately, where some have looked at both and said, hey, the new one, I actually like it a little bit better in some respects. Overall, depending on what option and what company you like, I mean, whole life insurance is still a solid option. The new product will likely produce the same results over time, specifically focused on cash value. I want to make sure I emphasize that point very, very clearly with all companies and products. All right, so let's continue on here. So MassMutual, as we mentioned earlier, has positioned their products to suit different markets. They made a lot of changes. Generally speaking, if the guaranteed rate is lower on a MassMutual product, that product is more focused on cash accumulation. Example, if you were to speak to MassMutual's home office or a MassMutual career agent, the messaging there has been very, very strong that the 10-pay product and 15-pay product are designed for cash accumulation, which is the case. When you look at them, you can do a lot of good with those. However, to play both sides, even though we use Mass heavily, when you look at those lower guaranteed rates, if dividends do come down a little bit, that's where as a consumer, I just want to have the awareness that, hey, the performance, I can be impacted a bit more with a 10 or 15 pay than I would with a whole life 100 or perhaps a product with a different company, just to provide awareness on that. That's the kind of stuff I would want to know as I see the different options. So some examples here, their whole life 100, they made a couple of changes with that. The guaranteed values among MassMutual products will look the strongest with that. The non-guaranteed cash values right now look the weakest with that compared to other products. They really designed this as a death benefit product. But with that said, you can still use this whole life 100 very effectively for cash value. When you look at MassMutual, I think I've mentioned this many times, that their sweet spot as a company with their products, with their old products, their legacy 100, you can do the same thing with the new whole life 100, is if someone says, I'd like a maximum cash value product. Like I want a 1090 split, I want the strongest guaranteed values, strongest upfront cash value, and I want the ability to pay into it for a long period of time, say for 50 years. Some people are attracted to that. That whole life 100 and what MassMutual allows with their different riders really accommodates that specific design. So it's still effective with that respect. But again, we want to make sure we're asking questions or your agent's asking them for you to provide that awareness. or providing the options. So we have full awareness. So second example, as we look at the 10 and 15 pay products, lower guarantees, non-guaranteed cash values, and even conservative non-guaranteed cash values, lowering the dividend interest rate, which I'm a fan of doing. These look good. Granted, they are more dividend sensitive, but a couple changes they've made with these products, like if someone's interested in max cash value with that 10 and 15 pay, you're going to see it as we look at the examples. They made a nice move as an insurance company relative to what's going on in the marketplace right now with those two products. Now, the drawbacks, if I pick a 10 pay or 15 pay, the number indicates how many years you can pay into the policy. So if someone says, hey, I'm looking at a policy for my child, or I'm 40 years old now, I'd like to pay into this for at least 30 years, or I see no reason why I'd want to stop. That's where those two are not as accommodating. I can't keep funding them. But if someone says, I really like Mass Mutual, I want to maximize the internal rate of return, these guys look good. Their L65 does as well to kind of give you a nice middle option where you can keep paying into it. But again, options and awareness. So awareness there, kind of hit on that nicely already as far as a product with a lower guaranteed rate results in the product being more dividend sensitive. So if dividends adjust, especially come down, I see those values impacted a bit more when I compare it with the original illustration, which we do that kind of stuff in our performance reviews. And I look at it nonstop because I'm an insurance nerd, meaning, hey, what does the original illustration look like? Then year over year as it passes, what does the actual performance look like? What companies have consistently delivered the strongest results? This stuff I always talk about. So let's continue on here. New product. When you look at the non-guaranteed values, specifically on the cash value growth and internal rate of return, stronger IRRs with the exception of the Legacy 100. The old Legacy 100 right now looks better than the new one. Why I say right now is because of the current dividend rate and current interest rate environment. They also made an adjustment with that new whole life product, Whole Life 100, where it's very, very focused on death benefit, but it can still be used for cash value. Like it has some strengths there. Now, here's a very important piece. Upfront cash value and PUA rider fees. If you've seen our Guardian video, what did Guardian make with respect to the adjustment on PUA rider fees? They were at 5%, they're now at 10%. You'll see most insurance companies are adjusting their PUA rider fees, which the guaranteed rate has an impact on that as well when you actually examine the product. Now, old products with the Legacy series, Lisser and Ailer, so Mass Mutual had it a bit different. With their Ailer, their current charge is 7.5%. This is with the old products. The maximum allowable charge is 10%. Meaning when I make an Ailer payment, which is a pure PUA payment, they have a gross charge of 7.5%. That's not 7.5% off the top. If you have questions on that, reach out to us. We do have some content that breaks down exactly how PUA rider fees work and what your net growth looks like too. But to stay on point here, 7.5% Ailer charge, 10% maximum, so they can raise it on old products if they want to. Lisser, which is another PUA rider with a term rider attached, current 8% charge, 10% maximum. Again, this is with the old product. New product. I got to emphasize this point because it's so important when you see the values here. Product selection is very, very important. Whole Life 100, higherly cash value, 65, 20 pay, which have a guaranteed rate, the Whole Life 100, 3.75%, and the other three at 3%. There's a difference. So in the charges, the Ailer charge is 10%, also with a 10% maximum. The Lisser charge, so before I do that, Ailer went up 2.5%. Lister went up 2%, was 8%, now is 10%. And look at this. They built in some additional room to increase the charges even more. For individuals that are concerned about upfront cash value, like what we saw with Guardian, this will impact it. When we look at the numbers, you're going to see exactly what I mean. I've seen a lot of real estate investors, business owners, value that upfront cash value sometimes more than the long-term potential. Because really a whole life insurance product, when you structure it properly, is going to produce between 3 to 5%. They say, if the money's there, if I can use it to enhance my real estate, enhance my business, that puts me in a better position and I'm going to earn a lot more with my real estate investments. Therefore, they value the upfront value, cash value that is. So that's your whole life 100, higher the cash value, 65 and 20 pay, 10 pay and 15 pay. Ailer, no change. Was 7.5%, 10% max, still is 7.5%, 10% max. Lister was 8%, still is 8% with a 10% max. Let's check something out here actually. So here's their whole life 100. As we look at this guy, so I'm sorry, whole life legacy 100. Here's the old product as we look at this guy. So what do we see here? Whole life legacy 100. Okay, let's go down to page 17 in this particular PDF. All right, I'm going to do it this way. So as we look at this guy, what do we see here? A lot of information buried in the illustration language. So actually, if I go back up to page 16, we'll see the Lister section. What is Lister? There we go. As we look at this guy, here's what I want to touch on. So what is Lister? Scrolling down, there we go. The charge is guaranteed not to exceed 10% of any rider premium paid in future years. But currently, well, skipped over that, currently equal to 7%. So good to provide awareness. If I scroll down next to Ailer, on the next page, here we go. Mecha test, it looks good, as we always like to test it. So what do we see here? Expense charge, 7.5%. That's the charge they presently have. You'll see the 10% maximum actually in their memos and contract language. So it's not on the full illustration. But as we look at this guy, so here's the new product. In fact, let me go back up to validate it. So we'll see the difference in the product name here, Whole Life 100, not Legacy 100. Okay, there you go. So let's scroll down here. Let's go down to page 17, in this particular illustration. They will not always be the same illustration, FYI. This is the new product. So we've got Lister here. Let me go back up to page 16 so we see it. What's Lister? Okay. Down here. Here's the change. Premium expense charge is guaranteed not to exceed 12%, currently equal to 10%. If we scroll down to Ailer, going to see the same thing. A lot of information. There we go. So equal to 10% of any rider payment. Those are the Whole Life 100 products. If we go to the 15 pay or 10 pay, let's go to the 15 pay here. So this is the new one. I didn't even look at the old one from a comparison standpoint because their old one, they do not allow you to do any type of blending with it, meaning Lister or Ailer, we can't add it. So I'm like this. No one ever wanted it, nor did I. Keep going. There we go. So let's actually start out at 16. Lister. What is Lister? Why I like to do this is to make sure we are looking at the right section here, just for full transparency. What do you notice? So this is a new product. When I say, what do you notice? It's buried in the language. Premium expense charge is guaranteed not to exceed 10% and currently equal to 8%. Has not changed. Same thing if we want to scroll down to Ailer. There we go. Current charge, 7.5%. Technical detail, right? And again, if you're a consumer, you may have fast forwarded through this part because you don't need to know all of this, but you will see it reflected in your net cash value when you look at the actual numbers in the policy, which we're going to look at very shortly. We're getting there. I know this is a deep dive, but it's important. So why the different PUA rider charges? Well, the reason why is companies have been struggling to maintain a profit with a guaranteed rate of 4%. I'm not going to get into details on this. We have some studies on this. You can just search on our YouTube channel, dividends and long-term performance, or how dividends really work. When you look at how the guaranteed rate and surplus rate is credited to a life insurance policy, there are differences on the base premium component and the PUA component. What you'll find is the guaranteed rate is equal to both base premium and PUA dollars, meaning the companies honor whatever that guaranteed rate is. They're not equal, but they're very close. With the surplus rate, there's a big difference between base premium and PUA dollars. It's much more sensitive. They can adjust it down, often do when you look at actual performance. So what they've had to do, because PUAs directly impact cash value more and it's guaranteed for a consumer, what they did is with products with a higher guaranteed rate, really 3% or more, and you'll see this consistent with all companies that have filed 3% guarantees or greater, is they've increased their PUA riders. This way they don't have this pressure, this feeling of, man, we cannot really risk our profits and other policyholders, which long-term doesn't make much of a difference when you really look at the numbers, but that's the overall the reason why. I know that can be deep, and we do have other content on it as well. So let's continue on here. Consumer awareness. I always talk about this. The greater the PUA allocation, meaning the lower that base premium is, the greater the guaranteed cash value. The greater the non-guaranteed cash value is in most illustrations, and the greater the actual performance is based on historical data. There's often, and a lot of times people ask this, and I used to try and find every way possible to make this work. There's talk that if dividend interest rates go up, a higher base premium should generate greater long-term potential. And that is true on paper when you look at illustrations, but when you look at actual performance, that has not been the case. And again, we've got some very, very specific detailed case studies that look at policies with all base premium, moderate blends, 50-50. If we look at aggressive blends, actual policies, not just projections that display otherwise. So my big thing is looking at the actual performance, like banks and corporations that we work with do, and making sure that a policyholder is set up for the maximum potential, maximum performance based on actual results, not just projections. A lot of information here. They had a big update when we look at them relative to other companies. So we're going to touch on the sweet spot and look at some numbers here. When I say sweet spot, like how to maximize products. We touched on their limits before. We can 10x the base premium with respect to a total payment. If you look at their whole life 100, strongest guaranteed values, solely focusing on the new products. Good option if you're uncertain on how long you would like to make contributions and you really like that strong guaranteed cash value. High early cash value, same thing of what it used to be, strong upfront cash values. Whole life 65 and 20 pay. When I look at those two, depending on your age, I like them. They really mirror, in my opinion, the old legacy 100 product, which depending on how long you wanted to fund, you could really customize it and could accommodate someone that wanted to fund for 10 years, for 25 years. These two are very similar to that, minus the upfront cash value. So one thing I didn't add here, when you look at these three, the break even is delayed 1 to 2 years compared to what it used to be. If your question is, well, what did it used to be? We're going to look at that in a second. So whole life 15 pay and 10 pay, depending on your situation. If you like the idea of funding for a short period of time, those two products are fantastic. To hit some summary points without going through all the details as it's written there, so you can certainly look through it. The 15 pay, we can design with LISR. You can do it with math with the 10 pay product, but it forces a higher base premium and it's not as attractive. You can design this with LISR, AILR. You can juice it where you'll have rich upfront cash values, strong long-term performance, and the flexibility to adjust payments one time per year, every year, without any medical underwriting. This is so important because so many times we work with individuals that say, hey, I want to pay in, say it's $50,000 per year. They pay in 50 year one. Year two comes. They can't do it. Life happened. Some other commitment came up. They can only pay in $10,000. Next year, they want to go back up to 50 or make up for lost time. If you have LISR attached, you can do that. If you don't, you're subject to the AILR rules, which are not quite as flexible. We've got other content on that. The 10 pay works very, very well if someone wants to fund for a short period of time, say 10 years, for instance, and they don't need or want flexibility. They say, hey, whatever my payment is, like if it's 250 grand per year, I'm going to pay in, and that's it. I don't need or care about the flexibility. The money's sitting there in cash. That 10 pay works very, very well. Again, specifically focusing on mass here. If you've worked with us, you know we show a number of products and companies and go through a lot, or just give you the high level points. But this is all focused on mass. I say that because I don't want to give anyone the impression that we only use mass. We use a number of companies. Before I sum it up with the last 2 points, let's look at some numbers here. So a lot of good stuff. We're going to go through material. So we've got the full illustrations as well. I'm going to touch on those as we just pull them up with their PUA analysis riders or their PUA fees. So here, whole life 100, 25-year fund, dividend values. Let's validate the design first. Because if I'm looking at this, I want to make sure someone's just not making numbers up. So if we go down to the design, come on. Almost there. There's the guaranteed values. This is the old product. There we go. There's the current dividend values. So death benefit, a little over $2.8 million, 2.9 here, which gives you a MEC limit of 106. Okay, 4% guarantee. This is the old product. Base premium, 10,000. Cash value, 87,765. Going back to the spreadsheet. There we go. So like we always do, we pull the numbers from the illustration, hop them on Excel. New product. A little too far, Steve. Fun stuff, right? All right. Everyone here at the office says, depending on your definition of fun, Steve, or our project manager, Anna likes to say that. She's a lot of fun. So same design here. Cash value, 83,834. Going back to this, what do you see it here? The new product on the right, 83,834. If we go back to that policy one more time, policy design is identical, $10,000 base premium. Death benefits a little bit lower, mainly because there's your MEC limit. That's what we're aiming for there. But policy design's identical. Like, why is there such a difference in the cash value? That's the question. Oops. And the reason why, this is their whole life 100 product. PUA fees on the new one have increased. That's why I see a difference there. It's not huge depending on the situation. If we take a zero off and it's 10K per year, you're going to see an identical situation. So both examples here, assume a dividend rate, 6%. It's based on their 2022 dividend scale. Annual IRR, that's your net growth year over year. Average IRR, this is both on cash value. Same thing over here. There we go. On the average, you're in the black, no longer in the red, once you're positive. New product, breaking even between years 6 and 7. Old product, very common for Legacy 100, healthy 40-year-old male, year 5. Funded this one for 25 years. What do you notice as time passes? We can scroll all the way down. The new one does not overtake the old one in terms of cash value performance. Based on everything today, this stuff does change. But as we compare it, the old whole life 100, the Legacy 100, gave more upfront and long term. When we look at the guarantees, here we go. So no dividends here. What do you notice? Old on the left, new on the right. Same thing up front. There's a difference there. Break even, check that out based on the guarantees. Not that much different, because the guaranteed piece, stripping everything out, when I say stripping everything out, dividends, all the extra juice, there's a 0.25% difference. As we look at things over time, very, very similar. Again, they designed their whole life 100 product to be more geared toward death benefit planning than anything else. Let's progress on. So we ran also the same thing with a 5-year funding option. Not going to go through every single one here. If we look at the high early cash value, here we go. What do we notice here? High early cash value product, old on the left. Look at that. Break even year 3, 95% right off the bat. Here's the difference. New one, 92% right off the bat. Higher PUA fees is the reason why. Breaking even between years 4 and 5. Rich cash value up front, but when comparing it to the old one, not quite what it used to be. Long term, if the dividend stays at 6%, you've got that greater long-term potential, right? So we see by age 65, they're almost the same here. 4235, 4215, and after that, you do see a difference. But again, you've got the 3% guarantee over here. In fact, if we go to the guarantees, that's indicated where the old one has stronger guaranteed values. Got to look at the pros and cons, right? Got to look at both. Can't just look at one. So there's the differences there based on the guarantees. So let's look at the L65, old and new. So as we look at the old one, look at this. With the design, this is with LISR, about 83% right off the bat. Over here, about the same. And the reason why with the new whole life 65, when we do the same blend, because we can carry a lower death benefit based on the Mecha test, to simplify the best I can drive the base premium lower. Very, very similar. Comparing the L65, which typically had a break even of year 6, same thing here. This is non-guaranteed, but the PUA fees, because I can drive that base premium lower now with that L65, they've also reduced the compensation on that product, which gives you a bit more juice in some respects. There you go. That one, I liked them all, but I mean, still, that's the kind of stuff I want to look at. Here's one thing I should touch on quickly. I know we've hit on it earlier. The dividend rate 6%. So consumers are going to ask, like, why is there such a difference in the dividend amounts here with the old and new? Reason why is, remember that dividend column is based on the surplus only. So the new product has a guaranteed rate of 3%, which means you've got a surplus of 3%. Whereas over here, the old product has a guaranteed rate of 4%. So your surplus is 2%. That's why I see a difference in the dividend columns. I don't really like looking at those. I mean, that they're important, but I like looking at the net cash value. That's more important because that's your actual value that reflects the guaranteed cash value growth as well. That is what I prefer, and that's what most individuals look at as well when they're really focused on cash value growth. So a lot of info here. If I'm to wrap up, we can skip over the 20 pay because I know this has been a lot of material. 15 pay product. Here's what I wanted to touch on. We'll look at the 10 pay as well, even though we touched on it earlier. Here we go. This is with Lister, everything blended. So a ton of flexibility, can fund it for a maximum of 15 years. Looks very similar to the old product or old products, breaking even between years 4 and 5. Based on the guarantees, check this out. So you're positive here between years 9 and 10. This is with the guaranteed rate of 2.5%. MassMutual's guaranteed values compared to other products other companies, I should say, have not always been the strongest. So for example, if we look at the L100, the old L100 with a guaranteed rate of 4%, which is right here, death benefit will be much higher. But look at this, guaranteed break even. This is a 5 pay between years 9 and 10. So what they did with their 15 pay, what it reminds me of, I only know this because we work with banks and had the privilege to compare the 7702 BOLI product, the old and the new. It's very similar to their BOLI product where the guaranteed rate went down, but since they cut their insurance expenses to a greater degree, there hasn't been much impact. Very similar there, which is fantastic as an option. Now, the drawback, can only pay into it for a maximum of 15 years, which some people will be fine with, some people won't. That's why I want options there. But I do like what they did with that because ton of flexibility, strong cash values across the board. They did a good job with that, in my opinion. You've got other 15 pays, 10 pay product here as well, different options. Quick overview. So RTR, you give up a lot of flexibility, but you get a lot of cash up front and stronger long-term performance as well. Whereas with Lister, just specific to the 10 pay product, sometimes we'll sacrifice some upfront equity. Actually breaks even here year 5. So what happens when my eyes go crazy from looking at so many spreadsheets. But great options here. So again, ton of information. You can tell I thoroughly enjoy the stuff. We also have some comparisons here, which we won't necessarily go into detail today, but we will have more content in the future in bite-sized fashion, like our other content. To wrap it up here, just for additional awareness, this is important. Agents know this for the most part. And from a consumer, like my viewpoint is this on compensation. Like agents should be compensated. There's a lot of work. However, the commission should never come into play where an agent says, hey, I'm going to take more commission, or the consumer, the policyholder's cash value is sacrificed at the expense of a commission. That's where the industry has issues, in my opinion, because when someone is very, very clear, their objective, they're saying, I'm buying a whole life insurance policy for maximum cash value. That's what I want. And they're sold something that generates a higher commission with less cash value than what they could have for some reason that doesn't make sense typically. That's where people's pain points exist. Like that's when I see the policies lapse, when agents are called, no good, sleazy, like that. I'm just hitting on it, not directed toward anyone here, but that's the kind of stuff we see occur so much. So why I mentioned that is MassMutual has made some big adjustments to their products. Their whole life 100, high early cash value have not really changed. Everything else has, where the compensation is lower than what it used to be upfront, particularly these guys. If you're subscribed to our agent training business, you'll have information on this with the exact grid. However, just to summarize, if you look at the 10 pay, what it is with the old product compared to the new one, or I'm sorry, if you look at the 10 pay now compared to the L100, it's about 30% of what it used to be. So a 70% reduction. 15 pay is about a 50% reduction, but they offer strong cash value performance relative to the change. So it is good to have awareness on that. If you're questioning the individual you're working with, you want maximum cash value, you want to fund for a short period of time. Maybe you've looked at a number of companies and you find MassMutual, that's the fit for you. Again, we use a number of carriers, but that kind of stuff is good to have awareness on. We found it has prevented buyer's remorse in a number of situations. Therefore, I like putting it out there to try and prevent those issues from ever occurring. But good to be aware of. We're always, our motto is convenience and transparency for the individual we're working with, customer service all the way through, and then whatever product you select, we ultimately set up, and then the compensation comes with whatever product you choose at the end of the day. It is a volume play, but we've got a fairly large company to help service the volume, and we continue to put more people on as well and train them properly. So overview, we'll wrap up. New products that comply with the 7702 changes offer greater potential in terms of non-guaranteed values. However, the guaranteed values have come down a little bit, but overall, they did a fantastic job with their adjustments, and they took on a massive task, MassMutual that is. Why I say massive task is when you look at the change, most companies filed one guaranteed rate, and that's a huge update with all of their products. They did 4 of them, 4 different guaranteed rates, and they did it in a timely fashion. So definitely a good option, still one of the 4 major mutual companies. We still are a big fan along with the other big guys. If you have any questions, please feel free to reach out anytime. And as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.